DSCR, or debt service coverage ratio, is a super important metric for real estate investing. For those that don't know, DSCR is the NOI, or the net operating income, divided by the debt service of the property. That's why it's a debt service coverage ratio. And when people refer to debt service, they're talking about, super technically speaking, from a lender perspective, the textbook definition is the payment on the mortgage that is the principal and interest. And this calculation is done that way even if the loan is fully interest only. So even if your payments are actually only interest and no principal, right, no amortization, you still would do the DSCR calculation with a principal and interest payment. And that's actually better. It's more conservative. And that's the way that lenders look at the underwriting as well. On the NOI side, NOI, things are a little bit murky, similar to how debt service is murky, because some people will provide a DSCR metric, even though it's actually calculating based only on interest. So if you're looking at someone's calculations, you're going to want to clarify and say, is this an amortizing debt service assumption, or is it an interest only assumption? And that's going to matter because that will influence what the number is. Someone might be showing you, oh, look, this deal has an amazing DSCR, but they're manipulating the numbers. Similarly, on the NOI side, you can manipulate the numbers as well, because NOI is classically revenue minus operating expenses. But we all know that the P&L doesn't stop there. You have more expenses than just operating expenses. You have one-time expenses. You have expenses like asset management fees and things like that that actually don't flow on the operating expenses. They're below the line. For example, you have accounting fees to have tax returns, K-1s. You also have legal fees, things come up, and you need to fully factor all those in to your cash flow. But when you're doing DSCR calculation, you would just do NOI, and then you do DSCR, and some people only take in the interest. So what I'm here to tell you is that DSCR is not the full story. And when we are analyzing deals, we're looking at a metric that we call loaded ICR. So we consider this a fully loaded metric where we take all of our expenses, not just our operating expenses, and then we divide that by our interest expense. And then that's the true cash flow ratio and the risk metric that you really want to hone in on when looking at deals. It's more valuable to look at this than cap rate. It's more valuable than LTV. It's more valuable than DSCR, and it's more valuable than cash flow. It's the best risk metric. If I could only know one metric about an investment, I'd want to know, what is that loaded ICR, the true net cash flow before debt service divided by the debt service. And that will tell me the health of the investment, not just relative to performance, but also relative to the debt